Assalamualaikum warahmatullahi wabarakatuh. Hello, we are from Group 4 and here we will present the material about the event and behavior approaches in accounting. And here are our group members and let's get into the material.
Event approach. The essence of the event approach is states that the purpose of accounting is to provide relevant information about economic events that is useful in various decision models. It is the responsibility of accountants to provide information about events that occur and provide users with events that are relevant to their decision models. And it is the responsibility of users to combine and assign weights and values to the data generated by events that are relevant to their respective utility functions. So, because of that, the number of characteristics and events is greatly influenced by observations that are relevant to various decision models. This approach encourages significant development of the accounting data presented. Not only monetary value, other characteristics of an event are also considered important to be disclosed in the financial statements. This approach assumes that the process of combining and evaluating accounting data is not entirely determined by the report preparer, but is left to the user. The next one is financial reporting and event approach. The first one is balance sheets. In value approach is current financial position, and in event approach is accumulation of all events since the company was found. The second one is financial reports. At the value approach, financial performance indicator in a certain period, and in event approach is direct communication of operational event. And the last one, cash flow statement. In the value approach is changes in cash in and out, and the last one in event approach is significant financial and investment. Normative event theory of accounting. Accounting theory regarding normative events has been tentatively summarized as an attempt to draw attention to people like shareholders, employees, managers, suppliers, customers, government agencies, and foundations in order to better predict the characteristic most relevant to significant events like internal, environmental, and transactional affecting the organization aggregate like incrementally and across sections, periodically and free from biased conclusions. Thus, the goal of accounting theory regarding normative events is to maximize the forecast accuracy of accounting reports by focusing on the most relevant features of events that are important to user. This theory states that first, an explicit taxonomy of real events which must be reported by accountants, and the second one, more effective classification planning with particular reference to labels that make it possible to associate certain events with other related events, and the last one, creation of an event-based accounting information system structure. Based accounting information system. One way to achieve the goals of normative event accounting theory is to integrate the event approach with the database approach to information management, which assumes that a company creates a centrally managed database to be shared with a large number of users with diverse needs. Such an accounting system includes the following models. The first one, the hierarchical model is based on the idea of an event accounting information system that allows its user to make scientific inquiries on a database. The second one, the network model is based on the concept of multidimensional of accounted that's stated by Idri and James, Colantoni, and Cooper. This model uses unstructured database input initially and also uses a collection of scientific questions or data that is then developed into a hierarchical data structure, which can minimize the number of records accessed to obtain answer to the question asked. And the third one, the relational model is based on the theory of relation in mathematics. Basically, a database is a collection of relations with various levels and different times. Users interact with the model through a language that is meaningful to the particular user. The important work to be done is to improve the application of the relational approach to accounting models. And the fourth one is the entity relationship models uses to the accounting system is modeled naturally in the database movement or environment as a collection of real-world entities and the relationship among those entities. This model essentially replaced the traditional chart of accounts and double entry bookkeeping procedures by viewing entity relationship in terms of entity tables and relationship tables. And the last one, the REA accounting model, is a presentation of generalized accounting phenomena, the components of which are consist of a set of presentation of economic resource, economic events, and economic agents. Evaluation of the event approach. The event approach to financial reporting has the main advantage of being able to provide more complete and relevant information about economic events that occur within the company. This information can support various decision-making models because the report users have access to the context and background of the company's financial changes, not just the numbers. Those users can customize the available information according to their needs and decision-making objective. However, this approach also has a weakness, which is the potential for too much information to appear, which can be confusing, especially for users who do not have a deep understanding of accounting. In addition, this approach tends to be subjective as it relies on the report preparer's judgment in determining which events are considered relevant. This can reduce consistency and make comparisons between companies difficult, as well as increase the risk of inaccuracies due to the greater emphasis on professional judgment.
Okay, the next material is the nature of the behavioral approach. Most traditional approach, accounting theory, construction have failed to consider user behavior in particular and behavioral assumption in general. The behavioral approach to accounting theory formulation emphasizes the relevance to decision making of the information being communicated and of the individual and group behavior caused by the information being communicated. The behavioral approach to accounting theory formulation is concerned with human behavior as it relates to accounting information and problem. And next, behavioral accounting. Also relatively new, the behavioral approach has generated enthusiasm and a new impetus in accounting research that focus on the behavioral structure within which accountant function. A new multidisciplinary area in the field of accounting has been conveniently labeled behavioral accounting. The basic objective of behavioral accounting is to explain and predict behavior in all possible accounting contexts. A more recent and exhaustive attempt by Dickman, Gibbons, and Swearinga illustrates the nature of studies of the behavior effect of accounting information. We may divide the study into five general classes. The first is adequacy of disclosure. The second is usefulness of financial statement data. The third is attitude about corporate reporting practices. The fourth is materiality judgment. And the last is decision effect of alternative accounting procedure. Next, adequacy of disclosure. This approach will used to examine the adequacy of disclosure. First, examine the pattern of use of the data from the viewpoint of resolving controversial issues concerning the inclusion of certain information. The second, examine the perception and attitude of different interest groups. The third, examine the extent to which different information items were disclosed in annual report and determine of any significant difference in the adequacy of financial disclosure among companies. The research on disclosure adequacy and use saw one, general acceptance of the adequacy among financial statements, and two, recognition that the difference in disclosure adequacy among financial statements are due to such variables as company size, profitability, and size and listing status of the auditing firm. The next material is the usefulness of financial statement data. Two approaches were used to examine the usefulness of financial statement data. The first examined the relative importance of the investment analysis of different information items to both users and preparers of financial information. The second examined the relevance of financial statement of decision making based on laboratory communication of financial statement data in terms of readability and meaning to user in general. The overall conclusion of this study were that One, some consensus exists between user and preppers regarding the relative importance of the information item disclosed in financial statement. Two, users don't rely solely on financial statement when making their decisions. So the next is attitudes about corporate reporting practice. Two approaches were used to examine attitudes about corporate reporting practice. The first exam preference for alternative accounting techniques. The second exam attitudes about general reporting issues such as how much information should be available, how much information is available, and the importance of certain items. This research item show the extent to which some accounting techniques proposed by the authoritative bodies are accepted, and also brought to light some attitudinal difference among a professional group concerning reporting issues. The next is materiality judgment. Two approaches were used to examine materiality judgment. The first examine the main factor determining the collection, classification, and summarization of accounting data. The second focus of what item people consider to be material, and so to determine the degree of difference in accounting data that is required before the difference is perceived as material. This study indicates that several factors appear to affect materiality judgment and that these judgments differ among individuals. The next is linguistic effect of accounting data and techniques. Linguistic and accounting have many similarities. Belko argues that accounting is a language and according to the Sapir-Whorf hypothesis is lexical characteristic and grammatical rules will affect both the linguistic and the non-linguistic behavior of user. Four propositions derive from the linguistic relative paradigm to conceptually integrate the research finding of the impact of accounting information on the user's behavior are follow. First, users who make certain lexical distinction in accounting are enabled to solve and or solve problems that cannot be solved by user who don't. The second, user who make certain lexical distinction in accounting are enabled to perform tasks more rapidly or more completely than those who don't. The third, user who post-process the accounting grammatical rules and more predisposed to different managerial style or emphasis than do who don't. And the last, accounting techniques may tend a facilitate or render more difficult various managerial behaviors on the part of user. These proportions have been empirically tested and verified in two studies that emphasize the importance of linguistic consider in the use of accounting information and internal standard setting. The next material is functional and data fiction. Functional fiction, organized as a concept, is psychology, arising from an investigation of the impact of past experience on human behavior. Dunker introduced the concept of the functional fixation to illustrate the negative role of past experience. He investigated the hypothesis that an individual prior use of an object in a function is similar to that required in a present problem would serve to inhibit the discovery of an appropriate novel use for the object. The next is concept of function and data fiction in accounting. Various hypotheses exist for both the functional and data fixation result in accounting studies, namely the condition hypothesis. It may be that the subject of experiments, mostly accounting students, have been conditioned to react to some form of accounting output and have failed to adjust their decision process in response to well-disclosed accounting trends. Prospect theory and farming hypothesis. Farming occurs because the wording of a question has the potential to alter subject response. Primary versus recency ego involvement. In matter of ego involvement within accounting technique just learn. Subject will give importance to what is perceived as relevant, significant, or meaningful. The next is information inductance. The individual behavior is influenced by information in two ways. One, through information used when acting as a recipient. Two, through information induced when acting. As stated by Prakash and Rappaport, an individual anticipating the consequence of his or her communication might lead him or her before any information is communicated and hence before any consequence arise to choose to alter the information or his her behavior or even his or her objective. This is the process information inductance. According to Prakash and Rappaport, time factors seem to govern inductance as follows. First, communication of information that is either in fact description of the sender behavior or is regarded as such by the information sender, or cornering which the information sender has some apprehension that it could be so regarded by the information received, will be strongly conducive to information included. Second, consequence that represent possible feedback effect on the information sender will be strongly conducive to information inductance.
The human information processing approach. This approach emerged in response to the need to improve how financial information is present and how users can utilize it more efficiently. Often complex and excessive information can hinder users' ability to make sound decisions. Its main goal is to understand how individuals receive, process, and use financial information in their decision-making process. This approach adopts theories and models from information processing psychology, allowing accounting researchers and practitioners to reframe accounting issues into more general information processing problems. In other words, rather than focusing solely on figures and financial reports, it also considers how the human mind works when faced with such information. Main components of an information processing model. First is input. Input focuses on the variables that influence how people process information for decision making. The main goal is to identify factors that make information easier or harder to understand and use. The examine variables. First is characteristic of individual skill. This refers to how information is scaled or measured. For example, whether it's present in absolute numbers, percentage, ratio, or other formats. The choice of scale can affect perception and interpretation. Second is statistical nature of the information set. This refers to the statistical characteristics of the database such as mean, variance, standard deviation, correlation, and so on. The statistics can provide additional insight and aid in decision making. Third is information content or predictive significance. It relates to how relevant and useful the information is for making prediction or decision. Information with high predictive significance helps forecast future outcomes or identify important trends. Four is presentation method. It refers to how the information is present in tables, graphs, charts, or narrative form. Executive presentation method can make information easier to understand and remember. And the last, for the The examined variables are context. This refers to the situation or environment in which the information is present. Context can affect how people process and interpret information.
The next is process. The process component focuses on how individuals process the information they receive before making a decision. Research in this component examines various internal factors in decision making, such as judgment characteristic. This means explains how a person makes a judgment about information. For example, whether a person tends to be more conservative or optimistic when reading financial statements. And the second one is decision rules. This refers to the strategies or thinking pattern used to make decision. For example, whether a manager uses a particular financial ratio rule before approving an investment project. The point is, the process component explains what goes on inside the person's mind as they evaluate and weigh accounting information. The last, output. The output component focuses on the end result of decision-making process, namely the form of decision or judgment made by the individual after processing the information. Research at this stage examines things like qualities of judgment. This means how accurate, consistent, or logical are the judgments made by users of information. The example is, can auditor consistently detect material errors in financial statements? And the second one, self-insight. This means measures the extent to which a person understands and is aware of their own thinking and decision-making process. The example, are managers aware that their investment decisions are influenced by personal optimism bias? Things to highlight is the output component evaluates the end results of the cognitive process and how the quality of that decision is influenced by prior information processing.
The behavioral approach in accounting recognizes that people are at the center of reporting and decision-making processes. Unlike traditional approaches that assume users are entirely rational, this approach highlights how decisions are often influenced by perception, experience, and social environment. Therefore, the behavioral approach focuses more on how accounting information is understood, interpreted, and used by its users. Behavioral accounting explores how accounting information influences human behavior. It looks at the connection between accounting and psychological factors like risk perception, biases, and social pressure. Though relatively new, this approach has led to important research that helps create more relevant and user-friendly reporting systems designed to match how users think and make decisions. Accounting information can shape attitudes and decisions. This behavioral affects into four areas. For the first is adequacy of disclosure, that refers to how complete and transparent financial reports are. Studies show that disclosure quality depends on company size, financial performance, and the auditor involved. Although many reports are generally seen as adequate, disclosure practices still vary from case to case. The second, financial data is only useful if it's clear and helps users make better decisions. Research found that while users and preparers agree on which information matters, users also rely on outside sources, not just financial statements. This highlights the need for reports that are concise, easy to read, and meaningful. Next is attitudes about corporate reporting practices. People have different views on how companies should report. Some want more detailed disclosure, while others find too much information overwhelming. These preferences often depend on professional background. For example, investors may prefer conservative methods, while managers may learn toward reporting that shows stronger performance. The last one is materiality, refers to whether information is significant enough to include in a report. Judgments about this vary widely and are influenced by one's role, experience, and the specific situation. For instance, an auditor and an investor may have different views on what's material. That's why understanding these differences is key to producing reports that truly meet user needs.
Next material is linguistic effect of accounting data and techniques. Accounting can be viewed as a language because it has its own terms and rules. This language structure in accounting can affect the way of thinking, decision making, and behavior of users of accounting information. Based on the linguistic relativity approach, there are four main propositions that explain how accounting information affect user behavior. First, accounting lexical distinction allows user to solve problems that cannot be solved by user who don't have it. 2. User who have specialist accounting words of term can complete text faster or more completely. 3. Understanding of accounting grammatical rules makes a person likely to have a different managerial style or emphasis. 4. Certain accounting techniques can make managerial behavior easier or more difficult. Several studies have empirically proven that linguistic aspects are very important in the use of accounting information, including in the preparation of international standards. In short, accounting language shapes the way its users think and act, much like language in a general context according to linguistic theory. Functional and data fixation. Functional fixation is a condition when a person is to fixate on old ways or previous experience, making it difficult to adjust to new information or change, including in the accounting context. For example, if someone is used to seeing financial statement in a certain format, then when there is a change in method, they tend to stick with the old way and ignore the new information, even though the change has been clearly explained. The decision-making process itself usually involves decision input, decision rules, and decision output. When someone cannot adjust their decision process to change in accounting data, it is a form of functional fixation. Some explanation why this can happen. First, the condition hypothesis. Habits or prior learning make it difficult for a person to accept change, especially in students or users who are just learning accounting. 2. Prospect theory and framing hypothesis. The way information is delivered or written can affect the way people respond, even the content is the same. 3. Primary versus recency ego involvement. When a person feels emotionally attached or proud of a recently learned accounting technique, they tend to consider it the most correct and ignore other approaches. Next is information inductance and time factors. Individual behavior is influenced by information in two ways. First, information use, when individuals receive and respond to information. 2. Information inductance, which is when individuals anticipate the impact of the information to be conveyed and therefore change their behavior, information, and even goals before the information is actually communicated. Information inductance occurs because individuals realize that the information they convey can have an impact back on them. So in order to avoid certain consequence, he may choose to repress the information or change the way he acts. There are two main conditions that influence inductance. First, if the communicated information is perceived to reflect the behavior of the informer, then the tendency to change the information will be high. 2. If there is potential feedback that could impact the informant, that he will be more compelled to adjust his previous information or action. So maybe that's all the materials from group 4. Thank you.